High dividend yield stocks are dangerous. Now, it's always a case-by-case study, but a lot of new investors get bought into the idea that high dividend yield stocks can be a free lunch. I mean, I get it. If a company posted a 10% dividend yield, that would be a nice form of income. That's so much more than the dividends of many well-known companies. But what often happens is that new investors get screwed in some way because these very attractive dividend yields are often very unsustainable. Investors tend to see a harsh punishment to the stock price that is often greater than what they would get in just dividends. Now, here's an example of a company with very, very high dividend yields, but the stock has fallen pretty deep over the years. Now, one way investors get screwed is that the company pretends that they can afford to distribute the dividends, but in reality, they don't have the profits to do it sustainably. So they dig into their savings. Similar to people, when you dig into your savings, your net worth starts to drop. Now, second is that some of these companies tend to take loans to afford the dividend. At one point in time, the loans keep getting bigger, and the interest charges from the loans will be heavy and just hurt the company. Third, the company might issue stock and use the cash that they receive to pay all the owners a dividend. This dilutes the ownership and naturally causes stocks to lower in price. Fourth, the company will have lower profits in the future. If historically the company is known as a dividend investment and the stock took a hit from some sort of news, the dividend yield will be high temporarily. Now, if the news is related to lower profits in the future, then the company can't afford to pay their dividend and will eventually have to cut it down to a more sustainable level. Now, setting the expectation that dividend income will decrease tends to really depress long-term shareholders, which causes them to sell out and make the stock continue to drop afterwards. Fifth is the company has pretty much eliminated any form of growth in the business. They may be able to afford the dividend, but there's pretty much no profits left to reinvest back into the business. When a company has no growth, or in fact has negative growth from either the business dying or the competition taking over, investors don't like that, and they end up selling out of the business and causing the stock to drop even further. Now, if you like my content, please like this video and subscribe to my channel, as I'll be posting more of this type of content in the future.